new technology that can power the world. We are investing $30 million at our facility in Hyderabad to boost production capacity of transformers by a full 50% and a new line of production of switchgears. This shows our commitment towards working for the next India.
India's T&D future looks great, but really, who are you?
I am technology, and I'm making India energy efficient.
Bears strike with a vengeance powered by a surge in global risk aversion. Sensex slumps over 450 points. Nifty slides to near 8,700 in the sharpest sell-off seen since June 24th when the Brexit vote shocked the world. It's a widespread sell-off across global markets, be it stocks, commodities or bonds. It's the fear of US Fed fueling much of the panic. Emerging markets bear the brunt of the selling after Fed member supports an interest rate hike, alleging a bubble in global asset prices. And there's a Fed fear in the forefront and that of the Brexit in the background. Global bond yields, those particularly in Europe, surge amidst rising questions on the efficacy of easy money policy across the developed economies like US, Europe and Japan. The big bear of the Lal Street, Shankar Sharma, tries to calm nerves, says the fall in emerging markets including India is just a correction and not a trend reversal. The sharp fall in global bond yields will attract more foreign investors into India. Shankar Sharma is betting on mid and small cap stocks but is avoiding blue chips. Hello and welcome. You're watching a special telecast, the global sell-off right here on ET Now. I'm Ajay Sharma. Well, global markets roiled today on concerns over imminent rate hike. India also participated in the fall and retreated sharply from record highs which were seen just last week. We'll get you an expert panel to make sense of the sell-off and give a comprehensive analysis during this particular show. But before that, let's get you a big market opinion on the show. The big bear of the Lal Street, Shankar Sharma, is turning positive. In fact, he's trying to calm nerves and is saying that the fall in emerging markets right now, including India, is just a correction and not a trend reversal. In fact, speaking exclusively to your channel, Sharma also says that this sharp fall in global bond yields will attract more foreign investors into markets like India. He's also betting on the mid and the small cap end of the market and is avoiding blue chips. Here's a slice of that exclusive conversation with our Chief Editor, Financial Markets, Nikunj Dalmia.
I don't think this is a reversal. I think it's only a correction. So I think we should not be reading too much into it. When you have rallied 25% in 5-6 months' time, I mean, to expect that there cannot be a correction of 3-4%, even 5%, is being obviously ignoring the way markets work. So my sense is this is only a correction. This is not a reversal. These are opportunities that markets present quite regularly, and you have to take advantage of these.
Shankar, are you not worried about what Fed may do and what really could be the outcome of the US presidential election? I can throw in the China angle. So good old concerns which have haunted us in the beginning of 2016 and for the entire 2015, what are the chances that those good old concerns could come back?
Those concerns, in my view, will be restricted largely to the US markets, and I don't think you will see a spillover of that into emerging. Where you have a problem will be the US markets, which are at highs. Emerging markets are not at highs. So I don't think the problems will come to emerging markets. I think, relatively speaking, emerging markets will outperform, and if you look at the last 6 months, they have been outperforming. We will benefit or we will suffer based on what is broadly a trend for or against emerging markets, and I think the trend is for emerging markets for sure. And within that, India also has been, doing okay. Other markets have done a lot better, mainly because they were beaten down last year. But India started performing, as I said, in the last month or so. And I think the trend looks very strong in favor of India and emerging markets overall, for sure. From a purely equity market perspective, if your hurdle rate, which are bond yield as a base, if they come down, then as an alternate, equities will look good. And that's precisely why India in the last 1 month, 1.5 months has been doing relatively quite well.
Shankar, last time when we interacted with you, and it was way back actually in the month of March, and that time your view was that it's time to revisit the dirty picture, which is metals and some infra names. And my compliments, because metal stocks from the March lows have come up. Most of the road companies are up anywhere between 40 to 50%. So do you think this high beta trade adjustment is over, or metals and infra names still have a long way to go?
No, I think they have quite a bit of distance to go, given how crushed they were in February and March. And, that's been the space that, I have been focused on within the small cap space also, metal infra and, stuff that has been unloved, have done the best. And I still believe there's a lot of legs to that end of the market. I mean, as we have also spoken, the large cap end of the market will not give you anything earth-shattering in terms of returns. Because, you need genuine 7-8% economic growth for them, and I don't think that's going to happen. But the small caps and the beaten down small caps have done phenomenally well, not just the last 6 months or the last 2 years. I think that rally still continues.
Shankar, you've always sort of raised a red flag when it comes to financials. Now, you're bullish on India. Financials account for nearly 35 to 38% of the index weightage now. So, if financials will not do well, do you think Indian markets will struggle?
Yeah, which is precisely why the large caps don't appear very attractive to me. I mean, not to say that they're going to go into a bear market or anything of that sort. Far from it. But they will not give you eye-popping returns as the smaller end of the market will. And that's because you have financials and you have IT and you have pharma. IT and pharma's problems we understand, we all know. And financials obviously over-owned. I don't think they can give you 20-25%, on a compounded basis as an aggregate in the large cap space. Although mid-cap, small-cap financials, have been in a different world altogether.
Shankar, I'll quickly change the gears of the discussion and talk about commodities. When crude was at 110, you were the first man on the street you said that crude is a short. When crude, I think, was at $36, $37, you were the first guy who said crude is a buy. So what is your view on commodities and particularly crude?
I remain optimistic broadly on the commodity complex. And, crude, fell from 100 odd to 27, 28, which is when, I publicly said that this is, a great buy. From there, it has gone up 70, 80%. I think, immediate upside, if you're talking maybe, $5 or so is about all you can look at. But I don't think they're going to go back to the levels of the mid-20s or even the low 30s. I mean, that would be, very, very, in my view, a remote possibility. So I'm generally optimistic on this, on the commodity complex, and which is why I'm optimistic on emerging markets overall.
That's Shankar Sharma of First Global, also known as the Big Bear. But this time round, he's actually sounding much more optimistic on emerging markets, particularly India, and is recommending investors to look at the broader markets. He was in conversation with Nikunj. But during the show, we have lined up a special panel for you. Rajesh Kothari of Alpha Accurate Advisors, Dhananjay Sinha of MK Global Financial Services will be talking about his latest note on global macros. And also over the phone line, we would be joined by Gurraj Singh from New York. He's a global macro strategist and will add his comments and opinion on how he is looking at what's happening globally from his perch in New York. Gentlemen, all of you, thank you so much joining us on the show. But before we take the discussion forward, let's go across to our colleagues on the research desk to get a handle on what exactly played out today and where we stand right now. Darshan Mehta, Yatin Mota and Tanya Khosla are joining us. Darshan, talk to us about the damage which was seen in today's market and the internals you are reading from on the futures and options side.
See, extremely weak closing for the Nifty itself, because if you're looking at the spot on an intraday basis it went below the 8700 mark before recovering a little bit. The clear outperformers of today was the IT index, because if you're looking at it in such a weak market when the globally entire markets were falling, IT became the outperformer. It was gaining in trade. So counters like TCS, Tech Mahindra, Infosys, all of them gained in trade. Bank Nifty was the worst hit. Sensex was the worst hit because most of them fell in almost 400 points in trade today. Now PCR cracked both for the Nifty and Bank Nifty, indicating that there was a lot of selling pressure that was there. So the Nifty PCR fell in from levels of 1.18 to 1.09. The Bank Nifty PCR fell in from 1.09 to 0.89. Profit booking was clearly seen on the Bank Nifty. The open interest was down 11%. So probably if there is more weakness, there could be fresh short positions that could be built. And all the Bank Nifty stocks managed to end in the red. If you're looking at where positions were taken, call writers were aggressive from levels of 8800 right up to levels of 9000. Especially 17 lakh shares were added on the 8800 call, indicating that there is a lot of pressure coming in from higher levels. Put writers had to shed positions at these levels, given the fact that the premiums were actually rising significantly. What aided the Nifty? Counters like Infosys, Tech Mahindra, TCS were the top gainers. Counters like Hindalco, Bank of Baroda and Yes Bank were the Nifty laggards. But due to weightage, some of the counters that really pulled down the Nifty were counters like Tata Motors, L&T, ITC and ICICI Bank. Overall, if you're seeing the scenario as such, only 8 FNO stocks managed to end with gains. Almost 167 were down in the red. Only 5 Nifty stocks traded with a positive bias. Overall, if you can look at the screen across, there was red all across. In line with global cues, the Nifty fell in significantly today.
Thanks for that, Darshan. Yatin, talk to us about the massacre which was seen in the mid-cap space. This one clearly became the favorite darling of the broader markets in the last couple of days.
Today we had the mid-cap index which saw one of the biggest intraday declines since February 11. So that was the kind of correction that we saw for the year in mid-cap stocks. Of course, 165 stocks on the Bombay Stock Exchange were at lower circuits, clearly indicating the kind of selling pressures in select mid-cap counters. Also talking about Ramco Systems, TD Power, Tata Elxsi, Trent, all of these stocks were at 52-week lows, and we saw good delivery-based selling in all of these names. In terms of other, mid-cap losers, we had Reliance Defence, Anant Raj, Granules, Munjal Showa, BF Utilities, all of these stocks correcting anywhere between 5 to 15% on an intraday basis. And not only the cash market, but the FNO segment was also under pressure when we talk about select mid-cap stocks. HDIL, which was the top FNO losers, lost almost 11% in trade today. India Bulls Real Estate, Diwan Housing, Bharat Financial, Oriental Bank of Commerce, select PSU banks saw correction of nearly 7 to 8% on an intraday basis. So clearly, if you look at the mid-cap end of it, there was severe underperformance versus the Sensex and the Nifty, and probably from here on also, given the fact that we saw good delivery-based selling and unwinding in the FNO segment, there could be some further pressure as we open for trade on Wednesday.
Thanks for that, Yatin. Tanya, talk to us about how the valuation picture is looking right now as far as Indian market go, when you compare India with some of the global indices.
That's right. Let me take you firstly through the valuations that we're all trading at. In terms of the Indian markets, if you see, the Nifty is trading at a 21 times price to earnings book of about FY17, while the Sensex with its 30 stocks in it is trading at about 20.3 times. The mid-cap index, on the other hand, is slightly lesser, trading at about 19.7 times. Remember, the mid-cap index has also fallen more than 3% in trade today. In terms of its comparisons with its global indices and global peers, let me take you through the BRICS indices first. China is actually trading at 14.2 times, which is much lesser than what India trades at the moment. Similarly, with Russia, it's is less than half of what India is trading at, coming at 7.3 times PE of FY17. If you look at the MSCI Emerging Market Index, is also trading at somewhere around 14 times. The key thing to note here, however, is that Nikkei, which is the Japanese index, is currently overvalued by almost 27.6 times the PE of FY17. So all in all, if you look at it, India looks to be fairly overvalued, and that is one of the main reasons why we might have seen the EM flows, over the past couple of months, reducing significantly to India and increasing to its other indices that are less valued, that is China, Taiwan, etc. So this is something definitely to be noted. Now Nikkei, which is higher valued than India, has been underperforming all of its peers, and we are hoping that India doesn't go through the same route.
All right, guys, thank you very much for that quick update. Let's take the discussion forward with our panel then. Gentlemen, thank you very much for patiently waiting by. Gurraj, let me start with you. The US markets, as we speak, have turned mildly positive, almost flattened out. Even the opening for the US market was, very different from how rest of the globe traded most part of the day today. How did you read? Are things getting gradually priced in?
Yes, I wouldn't say so much that they're getting priced in. It's just a correction off the substantial decline from Friday and early this morning. The main factors which accounted for the decline, the potential, or at least potential shift with respect to the odds of the Fed moving next week, the quantitative funds related selling